Okay, folks, we're going to kick this thing off. I see some familiar names on the screen, so thanks so much for joining us today. Those of you that are newcomers to this event, my name is Mike Walker. I'm the president of the Voluntary Benefits Shop. We do this every month. We have a monthly webinar series that our broker partners can join to just to keep up to date on some topics regarding long-term care. We typically have a different topic every month, all related to long-term care. And this one, this week or this month, is about legislative updates. And we have done this a couple times this year already because it's been pretty fast moving in 2025, the legislative aspect of long-term care payroll tax. So that's what we're going to dig into today. Just a couple of reminders for you. You can enter questions into chat, and my great colleague Chelsea will be monitoring chat, and we'll get to those questions as we go. We'll also allow you to unmute, maybe either periodically or at the end, to ask questions as well. And from there, let's go ahead and get started. I did want to let everybody know that today's presentation is being recorded. So if you want to access it after the fact, you'll be able to do so. You can access it at our website, et cetera, and that type of thing. But it is being recorded, and I just wanted to make sure everyone was aware of that. So with that said, let me go ahead and kick this thing off. So again, a lot of you know me, Mike Walker from the Voluntary Benefits Shop. And what we do every day, folks, is we help consultants like you bring one very specific solution to their clients, and that is these life with long-term care hybrid programs. So all we do. I think that we are the best at it in the country. I'm certainly biased, but we do get very, very positive reviews from our consultant partners, our HR partners, the employees that go through the process. So if you haven't tried us yet for your Life with LTC implementations and you want to learn more about how we do things, certainly reach out to us. You can see here on the screen my email, our website, my phone number. Please feel free to reach out if you have any questions or if you want to learn more. Okay. So we're talking about long-term care legislative updates today. And guys, I'll just start with a little bit of some background. Again, long-term care, huge opportunity within the marketplace. Many of us are going to need it. 70% of us over the age of 65 will need some shape, form, or fashion of long-term care services. 20% of us will need that care for longer than 5 years. And here's a snapshot of costs. The median annual cost for an in-home health aide is about $78,000. The annual cost of care in a nursing home is about $111,000. And the annual cost of care for a private room in a nursing home is about $127,000. Estimated cost of care for the final 5 years of life for a person with dementia is about $367,000. Folks, these are big costs. Doesn't take long for us to really understand how this can negatively impact someone's retirement assets, family assets, ability to, be able to choose the type of care they want, et cetera, and that type of thing. And I guess that's the bad news. But hey, the good news is that's what we're here to talk about today, is some solutions that can help people in those types of scenarios. And we'll touch on that after we get through some of the payroll tax updates. I am going to throw a trivia question out for everyone today. I don't usually do this, but I'm going to throw a trivia question out. And you can either enter it into chat or you can unmute and answer the trivia question. The trivia question is, of course, on the screen, these are the national averages, but does anyone know what state has the highest average cost for long-term care? Anyone? Anyone want to put a guess into chat or unmute and give us a guess? Chelsea, do we have any guesses in chat?
No, but it looks like some people are typing.
Okay, I'll give you a minute just to type. But again, these are the national averages that you see up here on the screen. I'm actually going to give you the top 7 as we go down. Chelsea, any guesses in there yet?
We have one guest from Eric who said New York.
Okay, so Eric's guess is New York. I'm going to give you guys the top 7 down. New York is not in the top 7, believe it or not, but that's what people always guess. So the top 7 will go from 7 up to 1. Massachusetts at number 7 at $145,000. This is for just a semi-private room in a nursing home, not a private room, just a normal room in a nursing home. Massachusetts, 145,000. Minnesota, 148,000. Washington, D.C., 153,000. New Jersey, 161,000. Connecticut, 161,000. Hawaii, 164,000. And number one on the list, usually a big surprise to people, is North Dakota at 165,000. It's the lack of labor there, evidently. So 165,000 is the average cost of a nursing home in North Dakota. So again, those are the top 7 states, but regardless of the state that people are in, it is a big cost for people. And the other thing is, people are really misinformed. People think that long-term care services are maybe covered by their health insurance, Medicare, Medicaid. All of us on this call know that that's not the case. Medicare may provide some coverage, but only for a maximum of 100 days. And Medicaid only kicks in if we've exhausted the majority of our savings and assets. In fact, in most states, you literally have to have less than $2,500 worth of savings and assets remaining before Medicaid would kick in. And even then, it has to be a facility that accepts Medicaid. The point being, most people are not aware of these things. Most people are not prepared for long-term care services, and none of these are really planning vehicles for being prepared. Okay, so let's talk about some legislative updates. And I think the first thing to really understand, and if you're new to this call, maybe you're not aware of this, but the big thing that's driving this conversation at the state level is the strain that long-term care costs are placing on states' Medicaid systems. And these are 2021 stats. I'm going to show you some updated 2023 stats on the next slide. But I like this map because it breaks down each and every state. And the important thing to understand is that in any given state, long-term care costs represent generally somewhere between 15 and 40% of a state's total Medicaid spend. And you can see that there's exceptions to that, but most states are between that 15 and 40% threshold. And it's simply an unsustainable level of spending at the state level for Medicaid, for long-term care costs, especially as costs continue to increase. And so what states are trying to figure out is how they take the pressure off their Medicaid systems. And here's some stats for 2023, and this has some, various state highlights on here. But the big thing I want you to look at on this is over here, the second bullet point, cost associated to long-term care equated to 31% of the total Medicaid budget across the country. Okay. So across the country, it's 31%. That's a big, big percentage. And so this is a problem that, exists throughout the country, and states are trying to figure out how do they take the pressure off their Medicaid systems. And so for those of you that are familiar with this topic, you know that the state of Washington was the first state to take a crack at this a couple of years ago. And what they did in that state of Washington was they created a new tax on all the workers of the state that creates a very minimal state-run plan. I say minimal because it's a lifetime maximum benefit of $36,500. So it's a drop in the bucket when it comes to long-term care costs, but the tax is unlimited. So the more money I make, the longer I work, the more I pay into this tax, but my benefits capped at that very minimal amount. Now, what they did do in the state of Washington, that created a very interesting precedent for those of us in the benefits world, is they enabled people that had their own long-term care coverage, if they had their own private coverage, they could be exempt from the tax, okay? So if I have coverage, I don't have to pay the tax. And so what did that do back when they did this in 2021 is it created this rush of organizations to try to bring long-term care to their employees that would give the employees the opportunity to participate and then therefore opt out of the tax. And so organizations scrambled to do that. We helped many organizations in the state of Washington do that. We learned a lot about the logistics of, enrolling, educating, and all those types of things about life with long-term care then that we've been able to carry into our business moving forward. So it was an exciting time, but a confusing time for a lot of people as well. Now, there was a lot of problems with the plan in the state of Washington. It wasn't really that well thought out. Long story short, the governor stepped in, delayed the implementation of the tax by 18 months so that they could fix some problems. 18 months went by, they didn't fix any problems, and the tax started on July 1st of 2023. So people have been now paying that tax for almost 2 years. And they have had a couple of changes in the state of Washington, though. Originally, the program wasn't portable. Now it is. So if I move to another state and I paid this tax all that time and I move to another state and retire, I can still access that tax. But that's not the big thing that happened in the state of Washington. The big thing that happened in the state of Washington, you see highlighted down there on the second bullet point up from the bottom. This is the big thing that happened. Last year on the ballot on Election Day, so last November, they had this initiative on their ballot, 2124, that if it passed, it would have ultimately made the program in Washington, the tax, voluntary. And we all know what happens when a tax is voluntary, right? Nobody pays it. And so then the program would have gone away essentially. And you'd think that would pass, right? You'd think people would vote to not pay a tax. But guess what? The initiative failed. 55% to 45%. So the state-run plan stays in as is. Okay. Now they did, like I said, they made that portability change and things of that nature. So they did approve it a little bit. But once that vote happened, it stayed in place. Now, I know most of you aren't in the state of Washington. Some of you probably have clients in the state of Washington, but most of your clients aren't there. But why this is important is because this empowered all the other states around the country that have started to look at implementing a long-term care payroll tax. This has empowered them, many of them, to move forward with this type of legislation because the voters of the state of Washington spoke. They wanted to keep it in place. And so many other states have really started to take some steps this year as well. I will give you one other piece of note in the state of Washington in case you do have clients there. Originally, if people missed that initial exemption window, meaning they didn't have coverage and file for an exemption, they were stuck, right? So if I'm a new worker to the state of Washington, I have to pay the tax, even if I have coverage. If I'm someone that graduates from college and gets my first job, I have to pay the tax, even if I get coverage, right? Now, there is a bill introduced that would create a new exemption window of November 1st, 2027. It has not been passed yet. But I think the likelihood is pretty high that they actually do pass that. We'll probably know more in the next couple of months about that, and we'll certainly keep you up to date. But that would open up a whole new window for the state of Washington, and I bet you see a flood of organizations, again, in the state of Washington, bringing plans to their employees. Now let's talk about some other states, right? So California, no new news in California, but I do want to touch on a couple of things from California because it's an important state in the whole, kind of global or holistic, like look at this. In the state of California, they've been very, very pragmatic about this. They have 5 proposed plan designs that they have looked at. They've really taken their time on this and brought in a consulting firm to really look at this. And those 5 proposed plan designs vary greatly. I'm going to show you kind of a snapshot of them on the next slide, but they were presented to, they did an actuarial study. That actuarial study was presented to the governor, the legislator, the insurance department, in the end of 2023, beginning of 2024. Now, the committee kind of disbanded at that point in time. So nothing really happened after that. And nothing has really happened since. I hear that there is some buzz that it's going to get picked back up. It probably won't be until next year. I honestly think that the wildfires kind of got things sidetracked out there on people talking about a new tax and things of that nature this year. So it wasn't reintroduced this year. But here's a snapshot of what the 5 proposed plan designs look like in the state of Washington. And then there's a lot more details than this. This is just a real easy snapshot of it. You can see that they kind of vary from design 1, which is kind of similar to the state of Washington, to design 5, which is much more robust, okay, than the state of Washington. And there's a lot of different provisions in here as well. I actually do a webinar. I've done a webinar specifically to the proposed plan design in California. And it's a half hour in itself. So we won't spend all that amount of time on it. But what I did want to show you is what the proposed tax rates in the actuarial study look like. They go from, again, being similar to the tax rate in the state of Washington with Plan Design 1 to being much, much higher in Plan Design 5. You see a 3% estimated tax rate on Design 5. And some of these designs and the actuarial study also recommended an employer contribution. So in the state of Washington, it's just an employee contribution, but in the state of California, there are some plan designs which include a employer contribution. So we don't know how that's going to shake out. Who knows? But what I can tell you is the plan designs in the state of California that were presented did also offer the opt-out or include the opt-out for people that have private coverage. And I do think that most states will follow that formula. And sometimes people ask me, why would a state want people to be able to opt out? Don't they want to capture as much tax revenue as possible? And the answer to that is that they really want to encourage people to have private coverage, because if people have private coverage, they're much less likely to ever end up on Medicaid in that state, versus if they just have the state plan, which is in most states going to be relatively minimal. There'll still be people that end up on Medicaid. So what the states really want is people to have private coverage that's sufficient so that they don't end up on Medicaid. And that's why states will encourage people by incentivizing them to get coverage by having that opt-out. Okay, so I'm going to give you a couple of other kind of updates from this year. Connecticut, okay, so Connecticut, they've been going through this over the last couple of years, and they had a study that was, or a bill that was introduced that would have required them to do a study, and that study really hasn't necessarily finished as of this point in time. I mean, it was supposed to be presented to the General Assembly. I think there's been some back and forth there, but early 2025, they did have a new tax credit for premiums paid for long-term care insurance. So they're looking at that route too, a tax credit for people to kind of encourage people to get private coverage. That hasn't passed yet. We'll see exactly what happens. There's also some things going on at the federal level as well that we'll talk about with tax credit as well. Maryland, I know we have some people from Maryland on here, so I'll touch on Maryland just real quick. Nothing new in Maryland. Only thing I want you to know about Maryland is last year in 2024, they did have a bill that was presented that would have required the Department of Aging to have a study conducted on the feasibility of a state-run long-term care plan. Department of Aging pushed back, said they didn't have the resources to undertake it. Ultimately, the bill was withdrawn. The study didn't happen. The bill has not been resubmitted. And probably won't be, this year. It's kind of past the time period. But I just want you to understand, if you're in the state of Maryland, this is a conversation that has started. Certainly Maryland politically is the kind of state where this could happen down the road. I don't see it happening in the next year or two, but it is something to be aware of, down the road, as things happen in other states. Now, Massachusetts. So Massachusetts is a state that has, looked at this pretty seriously. They're basically taking the California approach. Okay, so they brought in an outside, firm to conduct the study, do the actuarial study and that type of thing. Looking at all the same things that the state of California has looked at. And they'll have a study that's going to be ready probably not this year, but probably next year is when the study will be ready to look at. But the final study, I should say, because there's been some drafts reported, but not a final study yet. So we'll see exactly what that looks like. But Massachusetts has been pretty pragmatic, like California. So I do think it's likely that something happens in Massachusetts. But again, none of us can tell you exactly when it's going to happen. But it is progressing down that path. And then Minnesota. They did have a final recommendation that was released in 2024. Basically, the recommendation is, hey, they need to establish an agency to really look at this, right? That was really what the recommendation said. And they are creating supposedly a cabinet on aging. There has not been any related legislation introduced yet, but there has been a lot of talk in this in Minnesota for years. So Minnesota is one of those states that something could happen here over the next couple of years as well. Now, New York. New York has some people that have really been pushing this over the years. You have Senator Shelley Mayer, who has been, a vocal proponent of state-run long-term care plans. She's a pretty powerful, senator there. She's introduced a couple of bills over the years. Earlier this year, and she introduced legislation about 2022 and 2024. It didn't go anywhere. But in 2025, there's been, two bills proposed. It would enact the Long-Term Care Trust Act. which would be a comprehensive state-run program. It does provide the opt-out for people with private long-term care coverage if passed the way it's written. They did take one step further this year in New York. They have a proposed budget that would allocate $2 million to a feasibility study. Okay, so that's a step they had not taken in the previous years with proposed legislation. So we'll see if the proposed budget passes that way, but it does allocate $2 million in the budget for a long-term care insurance feasibility study. Oregon, they're a state that many times follows the lead of Washington. And so they had legislation after the Washington voters said, let's keep it. Oregon introduced legislation. And so it's likely that some things happen in Oregon over these next couple of years as well. Nothing new in Pennsylvania, so we won't spend any time on that. Vermont is the last state we'll talk about here. And I think that Vermont is one of the states that is more likely than not to have something happen. You can see that there has been a couple of bills proposed. They have a due date on the study that they're proposing for findings to be delivered by January 15th of next year. Here's the step that they took that a lot of people haven't taken. They actually have a proposed date for collection of taxes to start on July 1st of 2026. So I do want to make sure everybody's clear. This has not passed in Vermont, okay? This is just a bill that has been proposed. So I don't want you to come away with this thinking that it's going to start, July 1st of 2026. But if passed the way it's written, that's what would happen. None of us know exactly what's going to happen. My experience has been this usually gets kicked down the road a little bit. But again, because those voters in the state of Washington did vote to keep the plan in place, it has empowered these other states to push forward, and something's going to happen somewhere over the next couple of years. And then from a federal level, I want you to understand the WISH Act. So Congressman Thomas Ciosa, from New York. I think I said that right. I get it wrong though most times, guys. But Democrat in New York, he's been talking about this, and he introduced this plan and got a Republican co-sponsor. It's formally introduced on March 11th. And it's basically a catastrophic LTC plan funded by an additional payroll tax split equally between employees and employers. So I don't know whether this has a chance of passing. In fact, when I first heard about it, I didn't think it did at all. But I can tell you that there has been some traction with this on the Hill. I know that there's been a fair amount of hearings about it and that type of thing. So who knows whether it's going to happen or not. I don't think it's going to happen this year, but I do know that it has more traction than I thought it would. So this is something that is, being talked about there. And so we'll see exactly what happens. I think it's kind of unlikely for a new federal payroll tax to go through, but it does have more legs than I thought it would. And then this is the Long-Term Care Insurance Act that Eric Burleson from Missouri had introduced, which basically would change the tax credit that people take for long-term care to an above-the-line deduction. Okay. It's currently just a tax credit, but they would change it to an above-the-line deduction for long-term care insurance premiums. So anyway, a lot of different buzz about long-term care around the country, a lot of different things going on. Many of you that, are used to working with us, and I see some of you on this call are familiar with the Life with Long-Term Care options. That's really the major, program that employers are utilizing in today's world, because there really are no standalone long-term care options on a group basis anymore. There's a few companies that sell individual standalone options still, but they require a lot of underwriting, and people can be declined and rates can increase, et cetera, versus these Life with LTC programs have a lot of benefits over that, guaranteed issue and rate lock and things of that nature. Now, a couple of things I want you to be familiar with here with these Life with LTC programs is, number one, on the left-hand side there, you'll see these are really fast-growing products. It's the fastest growing, probably both voluntary benefit and executive level benefit are these Life with long-term care options. 2023, you saw 22% growth in those products. The 2024 numbers aren't out yet, but probably even higher than that. But I want you to look at these Eastbridge numbers from the Eastbridge study. on people's desires for long-term care. 36% of employees wish that their employer offered long-term care. Look at the generational mix. It's not just us Gen X's and boomers, right? It's the Gen Zs and the millennials too. And that's what we find. We find that when we offer this product, Life with Long-Term Care, that roughly 50% of the people that buy the product are under the age of 40. So very, very broad product appeal. And 29% of companies say they're interested in offering or intend to offer long-term care in the future. And 51% of employees say that if offered on a voluntary basis, they would purchase it. Okay, so momentum out there, people wanting it and not just people needing it. Now, these products, these Life with Long-Term Care products, if you're not familiar with them, they're just a combination of life insurance and long-term care all combined together into one program. And here's just a really basic snapshot of how the plan works, right? So top left-hand corner, the plan has a death benefit where it's going to work just like life insurance would work. If you pass away, you have this plan, it's going to pay your family that death benefit just like you would expect life insurance to work. Top right-hand corner, it has that terminal illness component. It's going to pay someone 75% of their death benefit right away if they're diagnosed with a terminal illness. The remaining 25% would be paid to the beneficiary at time of passing. Long-term care is going to give me 4% of my death benefit per month if I'm in a long-term care situation for up to 25 months of needing long-term care. And once that 25 months is over, it doesn't end. It triggers my extension of benefits, which would give me 4% for another 25 months. So a total of 50 months of long-term care. And then even if I pass away during that or at the end of that, it's still going to pay my family my full death benefit, which in this case would be 100, or which in this case would be whatever it was that I selected when I chose the program. And the trigger for long-term care benefits, you're probably all familiar, is just the inability to perform 2 or more of the 6 activities of daily living, or severe cognitive impairment, which could be like Alzheimer's or dementia or anything of that nature. Now, folks, just to wrap up, here's like a real numbers example of how these Life with Long-Term Care programs work. Let's say I chose a $100,000 plan, and let's say I pass away. I have a heart attack or I have an accident and I passed away and I never need long-term care. It's just going to pay my family that $100,000, just like you would expect life insurance to work. Top right-hand corner, I'm diagnosed with a terminal illness. It's going to pay me 75%, or in this case, $75,000 right away. The remaining $25,000 paid to my beneficiary at time of passing. And then long-term care is going to give me $4,000 a month, 4%, or in this case, $4,000 a month for up to 25 months. Once that 25 months is over, if I still need care, it's going to give me $4,000 a month for an additional 25 months. So I get a total of 50 months of long-term care potential payments. And then even if I pass away during that or at the end of that, it will still pay my family my full death benefit, which in this case is $100,000. So in a worst case care scenario where I go through 50 months of care or more, this plan will have paid my family $200,000 worth of long-term care benefits, a $100,000 death benefit, for total benefits paid of $300,000 on my $100,000 life plan. So that's a pretty typical product structure. It can vary a little bit by state. It can vary a little bit by carrier. Some of the carriers may be actually 6% a month. One of the carriers goes up to 10% a month. So there's some variance there, but this is just a kind of a standard, format. And this is kind of typical of what an underwriting offer would look like. Employees can generally get 200,000 of life, 400,000 of long-term care, guaranteed issue, no health questions. They can go above that. They just have to answer some health questions. And of course, there's some GI for spouses as well. If you've never worked with us on this type of plan, here's kind of a snapshot of what our broker partners routinely earn. They're routinely going to earn about $500 and comp per participant. So if we enroll 10 people, that's going to be about $5,000 in first year comp for you. 1,000 participants is going to be $500,000 of first year comp. We do enroll a lot of this. Here's a snapshot of cases that we enrolled during the month of April. So you can see the type of numbers that we get. We do much, much better than industry average. Industry average is about 8% participation. We average almost 20% participation from the clients that we work with. So And we also average about $1,400 per participant. And then we'll wrap up. I'll just show you a couple case studies and then I'll open for questions. Here's a couple of case studies for you. 350-person trucking company. Out of that 350, 104 enrolled, generating $171,000 in premium and $68,000 in comp to our broker partner. Here's another one, financial services firm with 400 employees. We're 75 enrolled, high income earners, so 220,000 in premium and $88,000 in comp to our broker partner. And then even a smaller one, a 90-person private school. We're 27 enrolled for $48,000 in premium and $19,000 in comp to our broker partner. Okay. So let me pause there and see if anyone has any questions. Chelsea, are there any questions in chat, or does anyone want to unmute and ask a question that they may have?
There's currently no questions in the chat.
Folks, feel free to enter questions into chat, or if you want to unmute, feel free to ask questions. If you are not currently working with us on your Life with LTC needs for your clients, and you want to figure out like how to create a Life with LTC pipeline, how to execute on that pipeline, how to make the most of the opportunity, certainly reach out to here at the Voluntary Benefits Shop. We work with all the carriers that have this type of program, and we're here to help. And I'll just pause there and be quiet and see if anyone has any questions they'd like to ask. Any questions from anyone? Okay. Really appreciate your time today. Again, feel free to reach out if you do have any questions or if you want to talk about, how we here at the Voluntary Benefits Shop can help your agency create more revenue through the sale of life with long-term care programs. I do appreciate everyone's time today, and thank you so much.